Inflation is one of the most underestimated risks in retirement planning, especially for people who move abroad believing their monthly budget will remain stable for many years. When retirees relocate to a lower-cost country, the initial numbers often look comfortable, but inflation gradually reshapes those numbers over time. A budget that feels generous during the first year abroad can begin to feel tight after 5 years of cumulative price increases. Understanding how inflation compounds is essential for retirees living on fixed monthly incomes, such as $2,000. In this video, we examine how inflation changes retirement costs after 5 years abroad and what that means for long-term financial stability. Many retirees focus on current cost of living comparisons without considering how those costs may evolve. Inflation does not always rise dramatically in a single year, but steady increases accumulate significantly over time. A 3% annual inflation rate may seem modest, but over 5 years, it meaningfully reduces purchasing power. In some countries, inflation can exceed 5 or 6% during periods of economic stress. To understand the long-term impact, each major retirement expense category must be evaluated with inflation in mind. Housing is typically the largest expense in retirement and often the most sensitive to inflation over time. If rent begins at $700 per month, even a moderate annual increase compounds meaningfully after 5 years. In markets with strong demand, landlords may adjust rents more aggressively than official inflation rates suggest. Property taxes and maintenance fees can also increase, even for retirees who own their homes. Over 5 years, housing costs may rise by 15 to 30%, depending on the region. Utilities are another category where inflation gradually erodes retirement budgets. Energy prices are particularly volatile and often rise faster than general inflation rates. Electricity, heating, and water costs may increase annually, especially in countries reliant on imported energy. Telecommunications and internet services also tend to rise in cost over time. After 5 years, utility expenses can consume a noticeably larger share of a fixed income. Food prices are highly sensitive to inflation and global supply chain pressures. Groceries that initially cost $250 per month may gradually rise to $300 or more. Local agricultural production can buffer inflation somewhat, but imported items often increase faster. Dining out becomes progressively more expensive, reducing discretionary spending flexibility. Over 5 years, food inflation can significantly affect overall retirement affordability. Healthcare costs tend to increase with age, even without inflation, and inflation compounds this effect. Insurance premiums often rise annually, especially for retirees as they enter higher risk categories. Private healthcare fees and specialist consultations may increase above general inflation rates. Prescription medication prices can also rise, particularly for imported pharmaceuticals. Over 5 years, healthcare expenses can become one of the fastest-growing components of a retirement budget. Transportation costs are also influenced by inflation, especially through fuel prices and vehicle maintenance. Public transportation fares may increase gradually, reflecting higher operational costs. Vehicle insurance and repair costs often rise due to parts and labor inflation. In smaller towns, limited transportation options can amplify these effects. 5 years of steady increases can reduce mobility flexibility for retirees on fixed incomes. Currency fluctuations compound inflation risk for retirees receiving income from abroad. If the local currency strengthens against the retiree home currency, living costs effectively rise. Exchange rate volatility can amplify inflation beyond domestic price increases. Over a 5-year period, currency effects can significantly alter purchasing power. Retirees must monitor both domestic inflation and exchange rate movements. Stability and economic policy influence how inflation unfolds over time. Countries with stable monetary policy often experience more moderate and predictable price growth. In contrast, economies facing structural challenges may see sharper cost increases. Retirees living abroad must consider how national economic conditions affect long-term affordability. Inflation risk is not uniform across Europe and varies by country and region. Lifestyle choices influence how inflation impacts retirement costs. Retirees who maintain flexible spending habits can adapt more easily to rising prices. Those with fixed lifestyle expectations may feel inflation more acutely. Living in walkable cities may reduce fuel exposure, while rural living may increase it. Over 5 years, lifestyle adaptability becomes an important financial asset. A $2,000 monthly budget may feel comfortable in the first year abroad. After 5 years of cumulative inflation, that same budget may effectively feel like $1,800. Without income adjustments, purchasing power steadily declines. Building a monthly buffer helps absorb these gradual increases. Retirees who plan conservatively are better prepared for long-term inflation effects. Inflation does not eliminate retirement viability, but it reshapes expectations. Careful budgeting and periodic reassessment of expenses are essential. Understanding compounding price growth improves long-term financial resilience. 5 years abroad can change the real value of a fixed income significantly. Retirement success depends not only on starting affordability, but on maintaining stability as costs rise over time.